Hi guys, good morning and welcome to Moneycontrol. We're here to talk about today's announcements that were made by the RBI governor as the MPC meeting for the month of June 2022 was concluded. Let me quickly read out the big statements, the big headlines. First up, we know for a fact that the repo rate was hiked by the RBI by 50 basis points from 4.4% to 4.9%, which is a 0.5% rate hike there. In fact, RBI decided unanimously to keep the policy stance, uh, which is essentially of the withdrawal of accommodation. That is the big headline. And of course, lots of statements given on the inflation front. The GDP guidance, however, for FY20 was completely unchanged. Let's touch base with Ravi Krishnan from Moneycontrol, my colleague who joins me every time after the RBI meeting, the MPC meeting is concluded. And Ravi, the big headline today definitely was on the growth and on inflation front. But first, talk to us about this repo rate hike, 50 basis points. I think a very small part of the entire market was expecting a quantum of 50 basis points, isn't it?
Yeah, I think a lot of people thought that RBI would do another unconventional rate hike of 35 bits or 40 bits in order not to shock the market. But I think that a 50 basis point rate hike was called for because inflation fears are very real. Uh, you know, uh, so right now, see, as you see that RBI has also increased its inflation forecast for FY23 to 6.7%. That is a full percentage point. And even after that, inflation could still surprise on the upside. There are several private sector economists who are expecting it to cross 7% for FY23. May inflation might see a dip, but we should not call a victory over inflation if we see that number, because there are several reasons why high inflation will still sustain. Uh, because one, the primary reason is of course that there is this great uncertainty over the Russia-Ukraine conflict. This adverse global scenario is likely to continue for some time. Then also remember that monetary policy acts with a lag, so the effects of this action will take some time. Uh, and From the quarter four results of companies, what we can see is that manufacturing companies have kind of effected pass-throughs in input costs to consumers, but services sector companies are yet to do that. That could do another boost to inflation. So it is very important that the Monetary Policy Committee not takes its eyes off the inflation target.
Okay. At the same time, the CRR was untouched this time around. So is it coming in as a sigh of relief to bankers?
Well, bankers will definitely heave a sigh of relief because they don't get paid interest for it. Okay, I must admit I'm a little bit surprised. Why the CRR wasn't high, because it's of course bankers are saying that after all those reverse repo, whatever the tweaks that RBI had done, and after the repo rate hike also, system liquidity is has come back to neutral. Okay, so from the figures which the governor read out, it is he said it was around 5.5 lakh crore for May 5th to 31st. But if I remember correctly, RBI's own currency and finance report talked about some 2.6 lakh crore as a non-inflationary surplus that the banking system requires. Also remember that RBI has been talking about an orderly evolution of the yield curve, and because of the current inflationary and liquidity surplus conditions, it is not very easy for it to do secondary open market operations. But if it had hiked the CRR, that could have given it some ability, some space to actually go and buy government bonds in order to keep a lid on the yields shooting up. As it is, uh, the yield on the 10-year benchmark has crossed 7.5%. I believe it had, but I think it could cross 8% in the days to come.
Okay. Let's also talk about some important commentary coming in from the governor. We all know for a fact that the RBI has unanimously decided to continue their stance of withdrawal of accommodation, and he's also flagged off some comments and projections about inflation as well. In fact, for the first quarter of this financial year itself, it's looking fairly shaky. MPC has noted that inflation will remain above 6% till October to December period. So above 6% clearly is a big number. What does it mean for you and I, for the Aam Aadmi? Is it a matter of huge concern? Could things get much worse than they are already?
Yes, I think it is a matter of great concern because it is going to hit our wallets very clearly. So, as I said, look, the RBI itself has said that inflation will remain about 6%. In the first quarter, it has projected 7.5, if I am correct, and 7.4 in the second quarter. That's because, see, even after this excise cuts, on fuel and some states, cutting VAT, inflation is still expected to rise despite that. And as I mentioned earlier, services inflation is something which we haven't really seen yet. It will hit us now. So far, the primary reason for inflation has been, supply shocks. There have been supply disruptions, etc. But what will happen is, if you remember, the governor also pointed out that inflation was becoming broad-based. We are going to see higher pass-through, in the days to come. So this will all affect it will all affect our purchasing, power. We could see a lot of people cutting down on discretionary consumption. So there are many effects we need to be wary of.
Okay. All right. So clearly, inflation is likely to remain the above upper tolerance band as flagged off by the governor. But at the same time, as far as demand is concerned, there was a statement made that demand in the urban part of the world, urban part of the country is recovering and rural is gradually improving as well. So how does that add up? Because at the time when we're looking at a fairly high inflationary environment, demand recovery is actually quite contrary to that. Is it because the base was very low?
See, what has happened is that inflation has bitten rural India more than urban India. So people in urban India haven't experienced inflation to the same extent as people in rural India have. Now that will of course change as we see services inflation catching up. House rents haven't gone up by that much, but eventually they will because this broad-based rise in inflation due to supply shock. The fear is that it will feed into wages and it will lead to a price spiral. So this is what the RBI is trying to arrest, and this is the reason why I believe that the MPC needs to front load its rate hike. We shouldn't wait too long, and this is also the reason why in recent interviews the governor has not committed to 5.15%, which was the repo rate before the pandemic. He has not committed that 5.15% will be the terminal repo rate. By terminal repo rate, I mean the repo rate at which the rate hike will end. That which will signal the end of this cycle. So coming
Okay.
back to the rural versus urban thing. So when urban India also starts, facing higher inflation as the days goes by, so there will be some amount of demand sacrifice that we will see in this bit to control inflation.
We've heard of a lot of cautionary statements. Upside risks to inflation have materialized faster than anticipated. The RBI has unanimously decided to sort of withdraw their accommodative stance. All of this is okay, but what really is needed right now to sort of curb inflation worries, to spur demand, to sort of keep things under control, and at the same time, sort of push economic growth?
You are asking to have your cake and eat it too, which is not that easy actually. because a certain amount of growth sacrifice will be needed to keep inflation under control. See, the question is whether we can live with slightly higher inflation in return for good growth, or whether we are okay to sacrifice a little bit of growth to ensure that inflation remains under control. I believe that controlling inflation should be the focus of RBI, because and growth catch up can happen a bit later. So what will possibly happen is that, see, like Jayant Verma, who mentioned that 100 basis point repo rate hike is needed very quickly. RBI has already delivered 50, so maybe in the next policy it will deliver another 50 basis points of rate hike, so that inflation is under control. And remember that monetary policy acts with a lag, so we need to ensure that these rate hikes are front loaded. They happen as quickly as possible, so that inflation does not linger on and it does not drive up inflation expectations. Now, of course, the quick survey which the governor mentioned, saying that there has been a significant moderation in inflation expectations of urban households. But I mean, you look at the rebound in gold imports. That suggests that these inflation expectations will also inch up, and especially when you see it in food prices, etc. If they keep on increasing, that will also lead to higher inflation expectations. So this is the reason why the RBI must move decisively and quickly in curbing inflation.
So you're saying that if we do manage to achieve growth even amid all these concerns and amid rising rate environment, inflation, etc., it's still not a bad thing. So the fact that the governor has retained or RBI has retained GDP growth projections at 7.2% for this year, is it a good news then in that sort of context?
Well, see, it is good news in the sense that, despite revising their inflation predictions upward, they still believe that, growth will be at 7.2%. Of course, a lot is based on these high frequency indicators, which are, doing really well. In fact, even yesterday's edition of the Moneycontrol Pro Economic Recovery Tracker did show a lot of indicators doing well. The governor himself said that the recovery was firm. He alluded to, I think, the PMI numbers, capacity utilization has picked up in the economy. Investment activity is picking up. There is hope that government expenditure will crowd in, private investment also. So all said, there are expectations that the growth will remain resilient. We just need to ensure that inflation is kept under check, so that the growth expectations also need not be revised further, say in the next policy review.
So, what lies ahead then? Because markets have digested this well. We saw a dip come by in the initial part of the trading session today, but a fantastic recovery thereafter. What's giving the markets confidence, or what's giving this optimism?
I wouldn't really call it optimism. See, the market was oversold, and I guess a lot of people are kind of trying to exit their positions. I'm not sure that this will sustain. This
Or is it
recovery,
or is
as
it
in this
because the
rise,
market
will sustain.
expected something much?
I think nobody expected more than 50 basis points in the first place. Keeping in mind, what the governor has said, I think we should expect more rate hikes, in the coming policies also. I mean, well, we are now squarely in the middle of the cycle. So I think future rate hikes are also given. Uh, how much, and how they will be spread out is, I think, maybe RBI will say it is data dependent, and we'll have to see how it evolves. There is a bit of uncertainty there. But the consensus is that, most people are thinking that the repo rate will eventually end up at 6.25% by the time, rate hikes are done.
Okay, so what is your assessment? How many more rate hikes do you foresee for the remaining year?
See, by the end of FY23, if we are looking at 6 or 6.25, I think that it depends on how they spread out. Will they take, baby steps of 25 bits, or will they again do a 50 bits? I think they should be bold and going for slightly higher rate hikes. But we'll need to see how inflation evolves, how growth evolves, and depending on that. And RBI also does not want to spook the bond markets. It has to walk a tightrope in that sense. It has to ensure that rate hikes happen and inflation is under control. But it also doesn't want to let bond yields spiral out of control. So we'll have to wait and see. There is a bit of
Absolutely.
uncertainty there.
Lot of events also playing out globally. So let's see how that pans out. But just before we wrap up the conversation, Ravi, I want to talk about another big event that's lined up this week. US inflation projections slated for later this week. Talk to us about how that could also impact sentiment and impact markets, overall, whether it's from the macro point of view or the micro point of view, because we've seen dollar index strengthening along with the rise in US Treasury yields as well. So could these continue to spook markets world over?
Absolutely, in the sense that with the dollar index strengthening, it will put pressure on emerging market currencies, which we are already seeing. And with the interest rate differential coming down, people will prefer the safety of U.S. Treasury rather than emerging market, assets. So in that sense, it will have an impact on how India will be able to finance its current account deficit also. We will not see FPI say coming back in a hurry, if this trend continues. And if inflation continues to, continue rising in the US, then we'll also see the Fed getting more aggressive. All in all, not a good time for equities, especially emerging markets.
Ouch, that's not what I'm sure many of our viewers are hoping to hear. But yeah, I mean, that's what it is, at least as of now, how things are looking. Thanks, Ravi, for joining in and
Thank
for
you.
slicing and dicing today's big announcements and the commentary coming in from the RBI governor. Thank you guys for tuning in. We'll be back with more coverage and, of course, the press conference from the RBI that's slated for later today. So stay tuned to Moneycontrol.